Good afternoon, everyone. I hope you can hear us clearly today. Welcome to the second Omni Risk Return Industry Workshop. Please note that the use of AI taking apps are prohibited by our IT. So we just ask people that are using it to kindly stop it. My name is Athule Mpandle, and I'm a communications officer at the FSCA, and I will be your host for today. I'm joined by the Omni Risk Return team. We have Lorraine van Deventer. Lorraine, may you please switch on your camera so people can see you? Lorraine is the departmental head for Supervisory Framework. We then have Marrelie Victor, who's head of department for Financial Advisory and Intermediary Services. You please switch on your camera, Marrelie, so people see you too. And then we have Juanita Smith, who is a senior specialist in regulatory liaison. And then we have Akashan Rambasad, who's a junior analyst for licensing and business center. We're really glad to have you with us today as we explore sections 5 to 8 of the Omni Risk Return. These workshops are an important part of building a more streamlined and effective approach to regulatory reporting, one that works both for the industry as well for the FSCA. So to support this process, some of you may be aware, I'm sure a lot of you were here yesterday, but we recently published a few key documents on our website. So the FSCA Communication 19 of 2025, it basically explains the consultation and engagement process. And then we have the explanatory sorry, the sound is doing this. Is anyone else struggling with the sound? Someone just dropped a message that they're struggling to hear me. Can I get some thumbs up or stay close to them? Okay, I'm seeing thumbs up. Okay. As I was saying, we have the FSCA Communication 19 of 2025 that explains consultation and engagement process. There's also the explanatory memorandum that outlines the purpose and structure of the return. And then we have the draft Omni Risk Return template, the form at the center of this project. So if you haven't seen them yet, we kindly ask that you find them on the FSCA website. They form the foundation of what we'll cover today and will help give you more context to the discussion. So here's how our session will unfold. If you were here yesterday, then you are aware how it works. We are going to start with opening remarks from Marrelie Victor, followed by a presentation by Lorraine, and then we'll also have Juanita coming to speak, and then we'll open the floor for a Q&A session, right? If you have any questions while people are speaking, please drop your question on the Q&A section. It should be at the top of your screen. Please drop your question there, and we'll aim to answer as many questions as possible. With that, I'll now hand over to Marrelie Victor for opening remarks. Marrelie, over to you.
Thank you, Athule. Good afternoon, everyone. I want to start with a few opening remarks. Unfortunately, if you did attend yesterday, you're going to hear a repeat of that. But I do think it is important that we convey the same messaging to any attendees that are new today. So I would like to start off by saying that I think one of the big reasons for these webinars that we are having is to explain the different sections so that whoever is supposed to complete these returns understand why we are asking certain questions and what the risks are that we're trying to address. And for that reason, we really ask that you focus on the contents of the return, the specific questions. The return will later on have some functionality that we will work in. For example, some questions will be grayed out depending on the license that you add in the beginning when you want to complete the return, but that is only coming later on. So for now, please have a look at the questions and how we ask the questions and whether you're able to assist in providing the information. I think a very important message that I want to bring over today is that this return is one of quite a few tools that we have in our kit that we want to use to supervise entities. It's not the only tool, right? And it's a baseline risk rating tool. In other words, the purpose of it is to ask very basic questions that address the most important risks that we see across our financial sector from a market conduct perspective. And we want to risk rate our entities based on those questions. So this is not going to probably give us extreme detail, but it will give us an indication of a basic risk. And then we will engage with entities to have discussions should something come up. And there are certain things that we feel should be discussed. Our other tools will obviously be used to feed into this risk rating model and to help us supervise in a bit more detail. I also have to be very clear. I think we did see some confusion yesterday. We are not rolling out the Omni risk return and the Omni CBR. The Omni risk return is basically the new version of the Omni CBR. And the Omni risk return, if you did read through the information that we published, was created following not only the considerations that we put into the feedback that we received or the comments we received on the Omni CBR, but it also aligns with our new strategy and the implementation of our new SupTech tool that we will be using across the FSCA to help us be a better supervisor in terms of systems. The questions we included here, in our mind, really includes the basic questions we want answered in terms of the risk that we identified. So we do ask that you consider, if we ask certain information and you do not get it at this point, maybe really think about why you are not getting it, and how it can be obtained. And if you think that the question that we're asking may not be asked in the correct way, we would also appreciate some feedback in relation to that. So yes, we understand that you may have questions, but I think this is specifically what this feedback period is for, so that you can say for a specific sector, a question may not work in a specific manner, or you are not obtaining specific information, but think about how it is possible to obtain it. We want to make it very clear that you don't have to worry. This is not going to be the last engagement in terms of the Omni risk return. We have these webinars or these workshops now in November, but as this next point also points to, we realize that our sectors are different and that we probably have to engage in different manners with our sectors going forward. So next year, there will definitely be more engagements, and that would be over and above the pilot that we would run. And we will customize it to the different sectors. For example, if you are a sole proprietor, you have an FSP license, we realize that you may need some more guidance in terms of how the questions would apply to you, or how you should answer specific questions. So we will definitely not just rely on the webinars or the workshops that we have at this point and leave you there. There are some decisions that we still have to finalize. As you can understand, this is a very big project, and as we go on and as we get comments and as we discuss the matter internally, we realize that we cannot make a decision today and stick with it because something may change tomorrow. So, for example, when it comes to the frequency of reporting, we may start annually. It may be annually for some. There may be requests for more reporting for others. But this is a discussion that we will have with the industry after specifically, I think, the pilot that we have, when we see how that works. And it's important, the participation in the pilot. We are not entirely sure who we are going to include or how many entities we'll include at this stage. But what we do know, it is important that we include entities from all different sectors, operating models and sizes. So we have received some feedback in our inbox already from entities putting up their hands saying they want to take part in the pilot. And we ask that you also reach out if you feel that it's something that you're willing or that you can do, especially so if you are small and you are worried about being able to complete this return. We are also aware that, this return includes all the entities that we currently supervise as the FSCA. We are very aware of the fact that the risks are different and that some entities may have lower risks based on the licenses that they have. And the practicality of reporting will be reassessed during the pilot phase when we look specifically at all types of entities. And then lastly, I want to just really emphasize and ask that you please read and watch all the information that we publish on this return. It creates a whole picture and a whole story, and we think that it will really guide you in this journey with us. That's it from me. Thanks, Athule.
Thank you so much, Marrelie. I've decided to get a microphone. So I just want to know in the chat if people can hear me now. Please drop me a message. I hope it works. I had to get it from my neighbor quickly. So resourceful. Perfect. Thank you so much. So the problem is the laptop. Sincere apologies for that. Please note that these meetings, workshops are recorded and will be available on the website once the workshops have been concluded. So if there's anything you want to go back to, you will have the chance to go back to it, right? We're now going to ask Lorraine van Deventer to come through. Thank you.
Thank you, Athule. Just checking, can everybody hear me?
Yes, I see thumbs up. You're all good.
Excellent. Thank you. So good afternoon. So thank you so much for making the time to join. It's great to see such strong attendance at 3 in the afternoon. I know this is usually the time of day when both coffee and willpower is running low. So I'll try and make it as quick as possible. So I will be taking you through the sections of the Omni risk return we are focusing on today, and I'll give you a quick overview of why we are asking for this information and how it connects to our broader supervisory work. So as I go through my part of the presentation today, I know many of you might be thinking that we are asking for a lot of data, and that this is just going to add to your compliance burden. But I think it is important for you to remember that the information we are requesting isn't just for regulatory purposes. It can also give you some real insights into your own business, especially if it's not something you are currently tracking in a structured way. So using the data that you will be collecting and providing to us will actually also help you get a clearer and more consistent view of your own risks, and can even support some of your board reporting and internal monitoring. So this slide is just to give you a quick view of the overall structure of the return. It's divided into 12 sections, each focusing on a different part of an institution's operations and risk profile, ranging from governance structures all the way through to financial data. So for today's workshop, we will be zooming in on sections 5 to 8, which deal with customer assets, transaction activity, product terminations, and advertising and communication. So for those who joined yesterday's session, this slide will look familiar, so apologies for the repeat. But since not everyone in today's sessions attended yesterday, see this as just a quick refresher. So also, just remember that many of the data points we request in the return serve multiple supervisory purposes, and the interpretation isn't always one directional. So depending on the context, the same data can either increase or decrease an institution's risk. So it's not just about the numbers themselves, but about what those numbers actually tell us in the bigger picture. So we'll start with section 5. So section 5.1 looks at the total value of customer assets that institutions hold or manage, both at the start and end date of the reporting period, as well as the average value during that time. So the purpose here is to help the FSCA understand the scale of an institution's fiduciary responsibility. In other words, how much customer value is under its care. So obviously, the higher the value of assets, the greater the potential customer impact if those assets are mismanaged or lost or exposed to operational weaknesses. We are asking for average values because it provides a more balanced view over time. So start and end figures can fluctuate due to market movements or one-off transactions, but usually an average smooths out those variations. So it just gives us a better sense of the typical level of assets managed during the reporting period. As we start building up a bit of history with this data, we will also use it to spot trends and changes over time. So for example, if we see a drop in asset values, that could either point to customer dissatisfaction or weak portfolio management. And to rule out specific market conditions, we will actually be able to use benchmarking to help us tell whether the drop is something specific to that institution or its general trend across the market. So section 5.2 focuses on how institutions collect or receive money from customers, either directly or through third parties. So we have defined what we mean by collection. And as you can see, it is quite broad, intentionally so. And it really covers any situation where funds are received or handled for customers. And it includes funds collected into the collector's own account before being transferred, funds collected into a dedicated or segregated account managed by another entity, and situations where the collector merely facilitates the payment, even if they never actually hold the money. So in subsection A, we are asking institutions to tell us who collects these funds on their behalf, as well as the value of those collections during the reporting period. To help us understand the flow of customer money. So that's where it enters the system, who handles it, and whether any institutions are involved. We are asking you to break it down by the different types of collectors, because each type actually carries a different level of risk and oversight responsibility. So in subsection C, we ask for the value of all money collected directly from customers. So that means meaning payments made straight into the institution's own account. And this really just helps us to identify what the proportion of collections are, direct versus third parties. In subsection D, we ask for the total amount of collections, direct and third parties combined. But you don't have to complete this, as it will be a system calculated field based on the values that you will be providing in terms of subsection A and subsection B. So you can use that just to validate your own information. In subsection E, we flip the focus and we look at outflows. So the total value of payments made by the financial institution to customers. And this could include claim payouts, withdrawals, redemptions, or maturity payments. So any payment made to the customer during that period, you need to record that. So institutions that rely heavily on third-party and cross-border collectors obviously may need stronger controls. So some of this information will give us some very detailed, valuable detail that will guide some further supervisory monitoring and engagement. So moving on to the allocation of assets received. In this section, we focus on how quickly and accurately institutions allocate customers' assets after they have received them. So when we talk about allocations, we mean the process of assigning or applying the funds or assets received from customers to the correct accounts or products or purposes exactly as instructed by the customer or as set out in their mandate or other agreement. So for purposes of this section, the allocation is considered complete only when the funds have been correctly and fully applied in line with those instructions. So in this section, we ask for two main data points. So that is the number of fully completed allocations broken down by how long it took from receipt to allocation. And those periods are from as little as 0 to 2 days to more than 90 days. And the other data point we're requesting is the total number of transactions that required allocation during the reporting period. So we can understand the proportion that were completed on time versus those that were delayed. So the purpose of this section is really to measure time to allocation, so which will help the FECA assess whether institutions are processing customer instructions promptly and correctly. So these two sections, 5.4 and 5.5, focus on understanding where money is flowing from and to, particularly when it involves border areas, metropolitan regions, or higher risk jurisdictions. Both these sections only apply to accountable institutions supervised by the FECA for FIC Act compliance. So if you're not an accountable institution supervised by us, this section in the return will be grayed out for you. So section 5.4 looks at how funds move in and out of areas that may present heightened AML, CFT, or conduct risk. And institutions are asked to report the value of money received from and paid to customers residing near a national border, the value of money received from and paid to customers residing within a metropolitan area. So the distinction here is quite important because border regions are often more vulnerable to cross-border movement of funds and potential illicit financial activity. So section 5.5 focuses then on money flows involving foreign jurisdictions, specifically grey-listed and blacklisted countries. So here institutions must report the total value of money received and paid to legal entities or natural persons in both grey and blacklisted countries. And our focus here is to determine whether there are any disproportionate or high volume flows from some of these countries, because that may indicate increased AML CFT exposures and the need for enhanced transaction monitoring and stronger customer due diligence. So this section looks at unclaimed assets. So that is financial products or funds that belong to customers but have not been claimed or was accessed for a significant period of time. We have defined the concept or what we mean by unclaimed assets for purposes of this return, and I'm placing emphasis on that. And for purposes of this return, it means either assets that have not been claimed or paid to the rightful owner within 24 months of it becoming due or payable, or assets where there has been no activity, contact, or engagement from the customer for a period of 5 years. So institutions are asked to report the number and value of these unclaimed assets, broken down by how long they've remained unclaimed. And we have specified specific periods from less than a year to more than 20 years. And they must then also provide the total number of customers with unclaimed assets and the total value of all unclaimed assets at the end of the reporting period. So we do acknowledge that apart from the retirement funds industry, we don't yet have a formal framework for unclaimed assets across the sector or any formal definitions. So the definition here that we're using here is just a starting point for reporting purposes to enable us to get some level of understanding of unclaimed or dormant assets across the industry. And we do encourage you to share your comments or suggestions to help ensure that this definition is practical and appropriate for the purposes we are using it in this return. So section 5.7 looks at transactions across higher risk or more complex product classes, as well as tracking cross-border or offshore fund flows. Once again, the section only applies to accountable institutions supervised by the FSCA. And again, it's because these activities often carry inherent AML CFT risks. Here, we require institutions to report both the number and value of transactions during the reporting period, broken down into several product types that are listed there. We have another category. So this category basically covers or captures other financial products or instruments that are not listed. And this is merely to help us to determine the proportion of transactions conducted by the institution involving higher risk products. So under subsection C, institutions are also asked to provide the total value of transactions where funds were received from or paid to foreign jurisdictions, and the total value of transactions where funds were received from or paid to domestic sources. This breakdown also just helps us assess the proportion of offshore versus local activity. This section deals with arrear retirement fund contributions and will only be applicable to those institutions operating in that in the retirement fund sector, and it really refers to or arrear contributions refers to contributions that employers owe to retirement funds but have not yet paid over. So the purpose here is to measure how late those contributions are and to assess whether funds are being received on time, because persistent arrears can be a strong indicator of employer non-compliance or weak collection processes. So here we also require institutions to provide the value of contributions that are overdue across different time bands, as set out in the question on the slide. And they also need to report the total value of all contributions received during the period. So this breakdown will allow us to distinguish between short-term temporary delays, which may happen due to administrative issues, and then longer-term and more systemic arrears, which could indicate serious compliance or financial distress on the part of the employer. So one question that comes up is the fact that we already report arrears every month to the FSCA. So why are we being asked to report this again? So that's a fair question. And the key difference is, I think, that this section gives us an age analysis rather than just a monthly snapshot. So monthly reports tell us when arrears occur, but they don't show whether they're being resolved or if they're piling up over time. So this aggregated age-based view will help us track progress in addressing arrears and how long amounts remain outstanding. So now if we move to section 6, which deals with transaction volumes and distribution channels, this section focuses on how institutions distribute their products and services and through which channels customers interact with them. So it's divided in two parts. 6.1 must be completed by all financial institutions except market infrastructures and credit rating agencies. And 6.2 applies only to market infrastructures and credit rating agencies. So in section 6.1, institutions must indicate the number of transactions that took place during the reporting period, broken down by the type of distribution channel used. There are 7 specific distribution channels listed, plus one other category to capture anything not covered or not covered by the 7 specific channels. Just quickly to go through the channels, you have telesales and call centers. Here we not only want to know the number of the transactions conducted through this channel, but we also want you to break it down to reflect whether it's your own center or a third party's call center. And if it's a third party's call center, we want to know whether that third party is your heuristic rep, an FSP, or any other third party. And again, that other is really a catch-all. We look at your own branch networks and sales forces. Again, a breakdown into your own reps, heuristic reps, and your employees. Retail outlets, funeral parlors, and then FSPs that are not already captured by any of the specific categories. And this really captures any other FSPs that sell or distribute your product but aren't part of or is not a call center or a branch or a retail channel. We then also want to know if you use internet-based platforms. Here we distinguish between sales with and without advice, and whether it's your own website or a third party's website. We look at mobile applications, and then, like I said, the other, which is a catch-all, that we will use to identify any new or unique channels. So the reason why we are asking this breakdown is really for us to understand the distribution landscape and to assess which channels are most widely used across the sector, the risk associated with the different channels. So, for example, online and automated advice platforms generally carry higher conduct and technology risks, and there are more complexities because most of those platforms are driven by algorithms. And then there are also, we are trying to understand the dependencies or concentration risks where business relies heavily on a specific channel. And it just helps us to assess any potential continuity risks if that channel is disrupted. So this section essentially gives the FSCA a picture of distribution risks, and it shows where and how customers are reached and where operational dependency might exist. So section 6.2, you will see that here the focus shift from distribution to transactions given the nature of that industry. So for market infrastructures, we ask for both the number and total value of transactions processed, cleared, or settled, as this will help us understand the scale of the operations and the risk associated therewith. And for credit rating agencies, we ask for the number of ratings issued or declined or changed, as this will help us gauge the activity levels and operational scope of each of those agencies, and assess whether, especially when there are spikes in the volume of frequent rating changes, as that may point to capacity or methodological concerns. Let me just move. Okay. So on this side, section 6.3, here we focus on understanding the composition and the structure of an institution's distribution network. In other words, who is actually distributing the products and services on behalf of the institution, and how is that network structured? So the goal here is to give us visibility into the size, the nature, and the potential risk within each one of these intermediary bases, including any dependencies or conflicts of interest and governance oversight. So under sub A, institutions are required to provide the total number of independent intermediaries they use, and an independent intermediary in the context again of this return means anyone who is not employed by, have no direct affiliation or dependency on a single institution, and does not exclusively intermediate for any one financial institution. We then ask for a breakdown into FSPs, representatives of FSPs, and then a catch-all. So that would be intermediaries that don't fit into these categories. So this will help us understand how widely institutions rely on independent distribution networks. So under B, we look at so-called tied intermediaries. And these are individuals or entities that are employed or contracted to a specific institution and only sells or provides services in respect of the products of that institution. So that could be employees, non-employee representatives contracted to it, or FSPs that or others formally tied to that institution. So the reason why we want to understand it is, and why we want to understand the structure of the distribution channel is because if you look at tied intermediaries, they often have closer oversight and more direct accountability, but some of the risks, heightened risks identified there is the fact that it may create conflicts of interest, whilst independent intermediaries, on the other hand, although they can offer broader market access, they may raise oversight challenges if controls and monitoring aren't strong. So how we engage with our institutions and what the focus of our monitoring efforts will be might slightly differ depending on the structure being used. So in sub C, once again, you're not required, that's just the overall total. You're not required to calculate that. That will be an automated calculation. You can use that for validation. And then finally, in sub D, we for credit rating agencies, we ask for the number of ratings issued for entities that are significant fee contributors. So when we refer to significant fee contributors, we're talking about a rated entity or its related or affiliated entities that contribute 5% or more of the credit rating agency's total annual revenue, either through rating fees or related business arrangements. So this merely helps us identify where there might be concentration risks or potential conflicts of interest, which could compromise independence or objectivity in the ratings. So moving on to the next section. So this section focuses on understanding the stability of customer relationships, the resilience of product offerings, and the suitability of products by considering product or service terminations. So A and B look at products or agreements terminated by the customer. So this tells us when clients themselves are choosing to walk away. So high termination rates can be a red flag for poor product design, inadequate disclosure, or aggressive sales tactics. But remember, like I mentioned right at the start, depending on the context, it could also mean something else. So subsection C zooms in on life and non-life insurance products and asks for a further breakdown. So that's, for example, where the termination was a lapse, a cancellation, a surrender, or non-renewal. But this subsection only applies with reference to life and non-life insurance products. So each of these different risk each of these carries different risk implications, like I said, and it's important for us to understand and be able to assess how those risks impact the profile of the institution. Subsections D and E cover terminations initiated by the institution itself. So it's important just when you work through it, because sometimes when you read it quickly, you don't always see the differentiation. So this covers the terminations initiated by the institution. So that would be, for example, when a product is withdrawn or a policy is cancelled or the relationship is ended because of compliance concerns. And an example here would be the bank closed a bank account of a customer. So tracking these will help us to identify where institutions might be offboarding clients or products too aggressively, which obviously impacts customer outcomes. So some subsection F, this deal with trade cancellations, and only market infrastructures will be required to complete the section, and it distinguishes between cancelled, suspended, and rejected or failed trades. So if these volumes are unusually high, it may point to operational weaknesses, but just keep in mind this will only be for market infrastructures. So you will see, and unfortunately, that functionality could not have been built into the Excel spreadsheet that we've distributed to you, but certain sections only apply to certain sectors, and in the return that you will complete on the system, those sections that do not apply to your activities will be grayed out, so you won't have you won't have to complete those. So finally, in H and I, we ask for the total number of products and agreements that's still in force at the end of the reporting period. This just gives us a closing snapshot of your active portfolio. And in J, we ask for the number of credit ratings that were withdrawn during the reporting period. This section only applies to institutions that are accountable institutions. And here we're focusing specifically on early withdrawals from fixed term investments. Essentially, that's where clients take out funds before the contract's expiry. And here we're looking at identifying patterns that may signal potential AML CFT risks or product misuse. If we see frequent or large premature withdrawals, especially soon after deposits, this could indicate that products are being used to move or conceal funds rather than for legitimate investment purposes. And lastly, for today's session, this section looks at how institutions advertise their products and how they communicate with their customers through which channels, how much they spend on advertising, and whether any advertising material had to be amended during the reporting period. So the first section focuses on advertising channels. So here you are required to indicate all the channels that you've used during the reporting period, whether it's digital media, traditional media, direct marketing, or alternative channels. And we have broken these channels further down. So if you look at digital media, you must indicate whether you have made use of any of the subcategories listed under that channel, for example, social media platforms, search engines, online ads, or email campaigns for any of your advertising purposes. We then provide for an overall, again, catch-all under the other category. So that is if the institution has used a new or unique channel that are not specified in the return. In section 8.2, we want to know what was your advertising expenditure. So how much was actually spent on marketing? And then when this is struck over time, sudden spikes could indicate or could signal aggressive sales strategies or expansions, which may increase the risk of mis-selling and may require additional oversight. And finally, Section 8.3 covers amendments to advertising material. So this captures cases where adverts had to be corrected or withdrawn due to misleading or inaccurate information. So frequent amendments may indicate weak internal review processes or poor oversight of marketing practices, both of which would be key conduct concerns for the FSCA. So in this, I think this is as far as I remember, this is the last section that I will cover during my presentation. So this section looks at how frequently institutions communicate directly with their customers. But I think it is important to emphasize that this refers to non-marketing communication only. So we're looking at promotional messages or advertisements. We're not looking at promotional messages or advertisements, but rather the kind of engagements that support ongoing customer relationships. So, for example, any policy updates, product information, or service notifications. We haven't specified, so we kept it intentionally quite broad, as long as it's not for marketing purposes. So here, institutions must report the total number of customers who have received these non-marketing communications, and they must provide that information broken down by frequency, so from more than once per month to less than once per year. And it is possible that some of your customers receive communication within different frequencies, so that should be reflected as well. Also important to note here is that to avoid double counting, customers should only be counted once, even if they hold multiple products. So overall, I think this section will help us to gauge how well you are maintaining meaningful, balanced communication with your customers. I think, yeah, that's my last slide. Sache, I'm handing back now to you. Thank you, everyone, for listening.
Thank you very much, Lorraine. To everyone, I'm just going to ask again, if you have any questions, please don't drop them on the chat. Drop them in the Q&A session so that it doesn't get lost. And when it's time for Q&A, we don't miss your question. So if you've already done that, thank you. And if you've dropped it on the chat, please copy and paste in the Q&A session. Should be at the top of your screen. Juanita, please come in.
Thank you so much. Can everyone hear me loud and clearly? I think the sound issues are sorted. Great. Thank you so much. I must say, we're getting a lot of questions today, which is fantastic. We're trying to stay ahead of answering some of them in the Q&A chat. So please do keep them coming in, and understand that, for instance, I did not take typing in high school, so I'm trying to answer as fast as I can, but nice words might be missing in the answers. But we do appreciate all the questions that you're asking. Then in terms of my slide that I represent or I'm presenting today, so for the people, which I think is about 90% of the attendees that were here yesterday, they also know this, and it's in the explanatory document. First, we look at what is the Omni risk return consultation process. As you know, we're now in November, where we're busy with the first round of virtual webinars or virtual workshops that we're having with industry. The first round ends on Monday, and then where we initially didn't think we'll have a second round, we're starting the second round on Tuesday and ending on the 17th of November, with the second round still giving enough time for all comments to come in, which needs to come in by the end of November. That is when the consultation process closes. Please remember that all comments that you give have to be on the Microsoft Teams or on the Microsoft template. We won't be accepting any other comments except for that. We did say it in the explanatory webinar as well. So no uploading of any Word documents or any emails to the inbox. But I do think that these sessions, I do feel that these sessions that we're having now has really helped to answer a lot of the questions and already give guidance on the comments that we are specifically looking forward to receiving. In terms of where the Omni risk return falls in the bigger plan of IRS and the rollout of IRS for the FSCA, of which there's been a lot of communication. I don't know if Lorraine is trying to tell me to speak fast or to stop speaking because of the slide going and coming and going, coming. Lorraine's Or is it
No,
okay?
apologies. I'm not sure why it's doing that.
Okay. I wanted to say I don't know what you're trying to say to me. Okay, so in terms of where we fall within the bigger scheme, the IRS is a very big project for the FSCA. It's basically divided into 3 phases. Phase 1, it was the phase where we did the returns, which are currently being submitted by industry to us. And those returns that are going to stay with us have been built on the IRS. So and this refers back to what Marrelie said in her opening statement. The Omni risk return is just one of the tools that we use to risk rate and to help us assess the risks of an entity and the industry, to look at emerging risks coming, and to determine our supervisory plans and be more effective in the way that we supervise. It does not replace all other returns that you're currently submitting. What is happening is we're looking at those returns and we're seeing how we can possibly consolidate them or streamline them so that there's no duplication. And in that manner, we're trying to assist industry and also making the information that comes in to the FSCA more streamlined and more automated. That is why we will not be accepting in future PDF documents for most of these returns that we've built, because we actually want to automate the process. We want to be faster and more accurate with our analysis, and we want to be able to have very targeted encounters and engagements with our entities. We are not going to publish anything in terms of risk ratings of entities, but this is necessary for our supervisory plan. We're currently busy with phase 2 of the IRS. As you can see there, that is where we worked on the risk model that we're going to use from licensing straight through your supervisory process, and all the information will then feed into this risk model, which is built on the IRS system. And yes, the Omni risk return, because it's cross-sectoral, will feed into it and will be one of the main tools. And that is why it's important for all entities that are supervised by the FSCA to submit a return, and we can have a baseline of what your risk is and determine from there how is it best to supervise you that will suit your entity, your license, your business, and the activities that you do to also be future ready. As you can see, we're now busy with that streamlining process. And then when we look at the risk return, we know that we're going into a pilot phase where we will test it, which is very important for us. And as Marrelie indicated, we would really want to see as many participants as possible from the different sectors in the industry, big and small, giving the input. So in the pilot stage, it's not just about the bigger entities that can submit it via XML and how easy it is to build the systems, but it's also to see if the system is working for those that want to submit it on our portal. Is it user-friendly? Are you understanding it? And is it easy to save, go out, come back before you have to submit? And yes, we do have a declaration as explained in the explanatory document that would need to be completed. So a compliance officer can submit on behalf of an entity, but the entity's senior management or a member of the governing board or executive committee, as we put it in the explanatory document, will need to sign off on that return to confirm the accuracy of the information submitted. So the pilot process will start early next year, and we're hoping to finish it by end of August. And that brings us to phase 3. And in phase 3, we've started working on that a bit. It's already the licensing model and all the notifications and application forms that you are currently submitting on a PDF to the FSCA. We're trying to streamline those and build that into IRS so that that could also feed into your corporate profile that you have with us. And some of that information will also inform the risk model. Thank you, Chair. That is all from me.
Thank you very much, Juanita. We will now move into the Q&A session. We're seeing a lot of questions coming through. Loving it. Glad I'm not the one who has to answer, The Q&A session is one of the most important parts of today's workshop. So this is your opportunity to engage directly, ask questions, raise concerns, or even just share your perspective. So to make sure we hear as many voices as possible, we'll work in cycles. So first, we'll take 3 questions from participants who raise your hand. So you raise your hand, and then we will unmute your mic, and then you'll be able to speak. So after that, we'll then take 3 questions from the Q&A section. So if you type your questions in the chat, as I said, please copy and paste in the Q&A session. If you'd like to speak, raise your hand, we'll unmute. Please don't hesitate. Your questions and contributions are essential to this part of the process. Your voice truly matters. So I'm seeing some hands. Let me start with Kalia van der Merwe. Akashan, can you please unmute Kalia?
Thank you. Thanks for this. This is extremely informative. I was typing my question, but I think it's very long and it's probably confusing. So under section 5, I've read through it again and I've asked the question on the side that Juanita has answered. But just for my own clarity, we are an FSP, we provide only advice. So there's no flow of funds in any form ever to our FSP. And if I look at, sorry, that's my snack alarm. If I look at the wording in section 5, it appears that it's the people who receive the monies or the assets or that allocates it. So nothing in section 5, from what I'm reading and understanding, looks like it's applicable to a Cat 1 FSP that only provides advice. So if I'm incorrect or mistaken, please tell me so I can apply my mind properly to it and just see where then I'm not understanding the section.
Thank you very much, Kalia. Akashan, can you please unmute Pinar and Johannes du Plessis? We'll start with, I don't want to say your name incorrectly. Is it Muhammad Pinar?
Yes, you can call me Azid. That's my first name. I don't know why it's like that. Okay, so there's a question from our side in section 5 as well. So, I'm part of the SAL, or I operate in the SAL captive space. So, as the insurer, so I got a 2-part question. So, just trying to understand what assets means for a SAL captive, and I think there was another question by a previous counterpart that I used to work with, is in another entity that's asking the same question in relation to that. And in the second part of the question that I have in relation to collections. So I just want to understand. So I think A is fine, but there was a comment made in relation to when, so as the insurer, the bank accounts is in the insurer. So we as the legal entity will open the bank accounts for the premiums to be collected into. However, let's just say ourselves, they will facilitate that collections into our bank account. So via either, the 5 or 6 major banks that we have. But then also what we allow them to do is to have third parties that facilitate that depending on how they want to set up that premium collection. So in some cases, it will be where they would directly collect the premiums from this, or send the bank instructions directly from their systems to collect the premiums into the insurer's bank account, or they'll use a third party if the system is unable to do that. They'll have a third party agency that will facilitate that, but the money at all times in the scenario that I'm painting, or the money gets collected into the insurer's bank account. So I just want to understand how do I fill that in section 2. That's the two questions that I had.
Thank you. Johannes, you may come through.
Thank you. I think my question also relates to the first and the second question that was asked. I also, in 5.2, find it a little bit unclear as to whether the question is directed at the financial intermediary or the FSP as to whether it's the FSP's responsibility to answer the question for the conduct of the premium collector, or is it then directed at the actual premium collector to answer the question and not the FSP? Thanks.
Thank you very much, Audrey and Tembisile. I'm going to ask that you please keep your hand up. So the team is going to answer these 3 questions, or rather 4, and then we'll go to the chat, and then we'll come back to people who have their hands raised. So please just keep it on so that I can still see your number and your name. Okay. Lorraine, Marrelie, and team, you may come through with your responses.
Thank you. So I'll try and take a first stab at some of it, and then definitely handing over to the team, especially relating to the cell captive questions. So I think the first question was, if I'm an FSP, or if I'm a financial institution and I don't hold or manage any assets on behalf of customers, will Section 5 apply? The answer is no. So if you look at Section 5, the requirement is that you, and especially the part in terms of 5.1, the requirement is that you must either hold the assets or you must manage the assets. If you're not doing that, you have to provide a 0 value, because the fact that you're not collecting, or the fact that you're not holding assets or not managing assets in itself is an indicator of risk or the absence of risk. So in that part, you'll have to reflect a 0 value. If you touch money, or if you manage money, even if you don't directly hold it, then obviously you will have to complete that section. On the collection side, so if you look at the definition of collection or collected, it is very wide. So it will include instances where a person facilitates the collection. Even if they don't touch the money, or even in instances where the money doesn't flow through their bank account. So in the example given by the commentator, they said that they open a bank, or the money is collected directly into the bank account of the insurer, but that collection process is facilitated by a third party. Then it would be captured by the definition of collection, and the institution will have to reflect the value of that money or the collection through that through the third parties. I think what was the other question here is on whether, I'm sorry, there were so many questions, I haven't captured all of them. The other one also related to collection, and that is that they were not sure when should values be, so they're not sure when the payments should be made, or information should be provided, if it's the FSP or the insurer or the collector. So here, I think the structure is, and we can probably clarify a bit more. So definitely, if you could provide written comments on that as well as part of the comment period. But the first part of Section 5.2 deals with the money collected on behalf of the financial institution. So that is the financial institution completing the return. So if you are completing the return, and if you are making use of third parties to collect money from customers, even though you are going to unforward it to another party, you need to reflect that information. The same applies to where you collect it directly from the customer and then on forward. So it just depends whether it's collected directly or whether it's collected or you're making use of a third party. So what we will see is that an insurer will, for example, if the money is collected on behalf of the insurer will reflect it as money collected by a third party. And if you were the institution that collected it and you were the collector, you will reflect it as direct collections. I hope that makes sense. If I can then, Chair, hand it over back to you. So maybe if one of my insurance colleagues can assist with the cell captive. Thanks.
Colleagues, is there anyone else that would like to come through to provide a response? If so, please switch on your mic and camera. Thanks, Marrelie. And then Liaison.
I also see Juanita's camera is on. I just have a question on the question about the cell captive. I'm not sure I understand, or maybe I didn't catch it properly, but remember the cell captive is going to report, probably because you have an FSP license, right? The owner of the cell captive. So you are, even though you have an insurer in the background, that's the underwriter, you will be reporting as an FSP, and that then goes back to Lorraine's explanation of, are you collecting, which may mean you are touching the money yourself, or you are assisting in some formal way in getting that money to the insurer. I don't know if you want to give more on that question. Juanita, did I misunderstand?
Yeah.
Can you come in?
Yes.
No,
Maybe
I
can
think it
just,
was different. Sorry.
yeah. So maybe I can
you
just
proceed.
explain quickly. So we have, so as the insurer, the bank account, when we onboard any entity or any investors that want to do business on our license. So we the underwriter, right? So what we'll do is we'll open up the bank account, right, in the insurer's name. That bank account is then where the money will flow into. As the binder holder or the intermediary, or there's different parties involved, it depends on who we have the arrangement with. If that entity says they want to bank with a specific bank, we then, get them in contact with the bank and they then set it up. However, the systems that they use is outsourced, meaning we outsource that system. We outsource that function to them. So we don't have our own administration system that would collect the money into the bank account. So they will have a system that they will say, this is a system that we want to use. And this is the system, for example, doesn't allow for money to be facilitated directly into our bank account through a process. We want to use a third-party agency that has that facility that can link to that system, that can then collect the money into our bank account. So the question for me is, do I then categorize that under 5.2a, or do I categorize it as me as the insurer collect? Because the money is coming directly into my bank account, but there is other entities or third party or agencies, for example, that facilitates the collection. It doesn't go to anyone's bank account but my bank account. So it goes from the customer. It gets debited from the customer directly into my bank account, and that's how I set it up. But there'll be, collection agencies that will facilitate from a technological perspective that the money move into the bank account. So I'm just trying to figure out where do I, complete that section as the, for the answer institution that needs to do the return, because I would need to get this information from these different cells operating on my license, but I need to make sure that I'm completing it correctly in that sense. So because from their perspective, they'll say third-party agencies, but do I say that if the money is coming directly into my bank account? I don't know if the explanation makes it
Yeah,
making it
so I
clearer.
see Lorraine wants to come in. I just want to ask one clarity question before she comes in. Because I heard in the beginning you said you're a first party cell, but now you're speaking as if you're a normal cell captive.
Insurer. No, so we're the insurer that does the underwriting.
Yes. Yes.
These third party and first party cells that we'll have on our license.
Mhm.
The third
Okay.
party cells
So you
is the one.
have first
So
party
we
cells.
have those
Okay.
third and first party cells operating on our license. But the way we set it up, so legally we need to have the bank accounts in the insurer's name so that we can make sure that we're collecting the money and we can control it and so forth, right? But the way we set it up, of course, we outsource all of the functions to these cells. Whether it's the binder holder, the intermediary, that's part of that cell, right? There's outsourcing that happens. And
Mm.
part of it outsourcing is premium collections, as an example, as part of the systems that they're using and so forth. So they will not dictate, but they'll say, look, I want to use this third-party agency to help me facilitate that premium collections into your bank account, right? But it comes directly
Yes.
from the customer. So they'll send a notification to the bank to collect a certain amount of premium. All right, but it comes
Yes.
directly into our bank account. It doesn't go anywhere else. But there is a third-party agency involved in the facilitation of the setup from a technological
Yes.
perspective.
Yes.
Yeah.
Just a further question for clarity, because we have looked at this in the past, and even when an entity says it comes directly into our bank account, it's
Mhm.
not in another bank account. There's sometimes a delay of 24 hours because it's about risk. So the
Yeah.
risk is it possible for the collecting agency, because it's not just about where you're going to complete it, there's a different risk attached to your collecting from the collecting agency or through the collecting agency, which is in A, or whether you're the person collecting directly from the customers, which is in C. So the risk is different, and that's what we want to measure correctly here. So what we found in investigations in the past is that there is a delay of 24 hours, sometimes 48 hours before it's paid into your account. So if something had to go wrong with the systems, it would not go into your account. It will be lying. So would that be any possibility in your case, or is it real time? Because real
It's
time
real
is
time.
different.
So it's real time. So the reason I'm saying it's real time is because whoever it is that we're banking with as the insurer, right? The client can choose whichever bank they want to bank with, but we have that relationship. So we got, the relationship with all the major banks. The facilitation, for example, like debit check and all, we assist from the banking side. The bank will assist the insurer to help the client set it up. I think where the confusion comes in here, in this question that I have, is that there is like a third party. So the client will say, from a technological perspective, my system can send the file to the bank to do the, so for whatever, whether it's end of month, 25th, whenever it is, the system is unable to create that file that the bank wants, because the bank gives a set of requirements. They then come and say, look, there's a third party agency, and that third party agency can be the link between our system, the bank that we're banking with, to facilitate. So they'll be the ones where they'll extract information from the system. They'll put it into the system that they are attaching between the two parties, and then create the file for the collection to happen. So that's still that setup is still real time, because the way we set it up, we still set up for debit check, we still do all of those things from the bank side for the bank account. But it's just that confusion around, there is a third party involved here. So what do I do? How do I complete this? Because in my mind, it would be directly into the bank account. But now I see there is like the explanations. If they're facilitating or assisting in the facilitation of it, then there is a part of it that I need to complete. But again, look, what I'll do is I think we've in Mutual, we have, given comments and stuff. So maybe I just should put the commentary there, and then we can maybe have a conversation around it, because the cell captive world is a little bit different in the way it's set up and so forth. So it's just understanding how we complete this and give you the most accurate information in relation to the information that you're asking to collect in this return.
Lorraine, you want to come in? But thank you. We have to be very sure how you put it, because I know there is that little nuances when it comes to the collection. Yes, Lorraine?
Thank you. So yes, so I think for how we have defined collection, it's like I mentioned during the presentation, it is very broad, and it includes where the collector facilitates the payment process. So based on what you have explained, I think you will have to record that as a collection by a third party and not as a direct, because to me, direct is that there's nobody in between. It's from the customer right into your account, and
Okay.
you're responsible for that whole collection. But here you have, and like you've actually mentioned that you've actually outsourced that function. So for me, there is a middleman that facilitates that process, and given the definition of collection for purposes of this return, you will reflect it under collection by a third party.
Okay, great.
But
Thank you.
please submit that comment, and
Yeah.
especially if there are any nuances because it's a self-captive, please record those as well, and why it would be different from a ordinary collection transaction between an insurer and an intermediary, so that we can understand those nuances and that we can take it into consideration.
Will do.
Thank you.
Thank you.
Thank you, Lorraine and team. Does that answer all 3 questions? Okay, perfect. We'll go to the chat. Juanita, I'm going to ask for your assistance with the Q&A. The ones that haven't been answered. I see there's a lot that have been answered already.
We are trying, but I think we might be missing some nuances here.
Okay.
And then maybe not responding in the way we should. So I'm going to one that we did respond to, but there was a comeback on it. Lorraine, when it comes to unclaimed assets and the explanation that we gave for unclaimed assets. So the question was, if I have a RA, and I remember we did discuss this, if I have a RA and I make it pay up when I'm 40, I will not contact the product provider for at least 10 years and there will be no activity. Does this mean the asset is unclaimed? I first responded by referring to the fact that we said it is, if there's no activity or engagement, 5 years, for 5 years, but it's not legally due yet. But I know that we also asked for comments on this and that we're interested in trying to define it further for fixed term products and where they should fall. However, then it was to say that the definition and the return says or. So what do we do with an RA that you made paid up at 40, which is not due 10 years later and there wasn't necessarily any activity on it? Would you want them to, oh, I see Audrey says she wants to
Yes.
come in and explain this. Maybe then, or can we, Akash, and unmute
Akash, can you
Audrey,
please
because
unmute
maybe
Audrey?
I'm understanding the question incorrectly.
Hello, everyone. I actually have 5 questions, but I'll start with the unclaimed assets one. If you look at the terminology sheet, the definition of unclaimed assets says A, have not been claimed within 24 months before they became due, before they became legally due and payable, or. So it's A or B. It's not both together. So B says where there's no activity. If I have a paid up RA at 40, you won't see me until I'm 50, 55. And that doesn't mean the asset is unclaimed, even if it is not yet legally due. So the definition says or. The question says, no, I just need to page there quickly. The question says 1 asterisk, assets legally due or claimable, assets that have not been claimed within 24 months of becoming due and claimable, and assets with no activity, assets that have not been claimed due to no activity or engagement for 5 years, but not yet legally due. So if it's not yet legally due and it hasn't been claimed and there's no activity, doesn't mean it is an unclaimed asset. So this definition must be 100% clear in what you want to achieve. Otherwise, you won't get consistent results. I've also had plenty comments saying the FSCA issued a discussion paper and would have engaged on a definition. That engagement hasn't happened. There hasn't been any further information. Now you require reporting with a definition that doesn't really make sense to us. Shall I keep the other 4 questions?
Yes, I think in fairness, let's deal with this one because it was on the chat, and we
Thank
just
you.
wanted clarity.
Yeah, so maybe if I can come in here, Juanita, if you don't mind. So yes, Audrey, we've had the FCA has been working on a framework for unclaimed assets. And unfortunately, due to other priorities, it was placed on hold for this year. So that's why there were no further engagement subsequent to the publication of those documents. It is still a priority, but it's just the focus for this year was just a little bit different. And I think that's why I emphasized at the start of that slide when we got to that question that we have defined unclaimed assets for purposes of the return only. So it does not mean that this will be the definition that will necessarily be incorporated into the final framework, because for that we still require quite a lot of engagement with industry, because there are other considerations that needs to be taken into account. So for purposes of this return, what we want to see is whether there are, and like you said, I agree the way that the definition reads, it's an or between A and B, paragraphs A and B in the definition. It's either the one or the other one that applies. So B, where there's no activity that's not linked to when it became legally due. So what we try to achieve here is just to get a sense of what are the unclaimed assets. So if a product wasn't claimed off when it became due, I think that's easy to report on and easy to identify. It's the second one that may be problematic, which I fully understand. And if we use the example of an RA, a paid up RA, or even if you use an example of an investment product that doesn't have a fixed term, when does it become unclaimed? So what we tried to do with the requirement in B was to say that if there was no activity on the account, or there was no contact or any engagement from the customer, in other words, for the last 5 years, there was nothing. You haven't engaged with the customer hasn't engaged with you, there was no activity, nothing, then that is an indicator that the asset might be unclaimed. And we want that to be reflected. So that will give us an indication of where assets are at risk of becoming lost or unclaimed. So that's the background to it, and that's the rationale for it, and that's how we have defined it. But like I said, happy to and we welcome very much any input from industry on this aspect. If you require more clarity, happy for us to do that. If you have any specific suggestions, keeping in mind what we are trying to achieve here, that would also be very much welcomed. Thanks.
Sorry, Lorraine, just a last question on assets. You mean all assets, including retirement benefits?
Yes. Yes.
Okay.
Thank you very much. Juanita, was that 3 questions on the chat?
No, that was question number 1.
Okay, you may proceed.
Yes. So the next one that we also need to give clarity to, that we try to respond, is also from Audrey. When we look at question 5.7, and we talk about product clauses and offshore transactions, she's asking which financial institutions is this aimed at. We answered by saying it's all accountable institutions, and if any of the line items are not applicable, to put in a 0. For instance, if you don't work with the securities or crypto assets. Audrey came back, she said, Lorraine, and I'm going to ask our investment colleagues to also consider
Juanita,
this.
Can I interrupt you so not to waste everybody's time? I think I figured it out. The question asks for transactions conducted. So if the financial institution does not conduct the transactions, they obviously do not report here, correct?
That is my understanding, Lorraine.
Okay, yeah.
Yes, so that would be correct, Audrey. They will have to input a zero value.
Then the next question is on 5.8. And this one, our pension fund members can also come in for an answer because it's about their rare retirement contributions. And the question is this only for retirement funds or is it for financial institutions as employers as well? My understanding is that the retirement fund will complete it from the retirement fund side, as they're obligated to do and provide feedback on a monthly basis on this. But if the financial institution is also an employer, Lorraine, would they complete this then for us? Is there anyone from the pension fund side that want to come in? I see
So maybe
Takalani's
if I might just ask the question for clarity quickly. So this return must be completed by the financial institution. And they will provide information relating to retirement fund contributions. So it will be completed by, so this is a section that will only be applicable to our financial institutions that are retirement funds and I think 13B administrators. So it will not apply to any other financial institution. So it will be grayed out in the final return for other institutions. So are you saying that where an institution is also an employer and they haven't made their contributions, you want to know whether that should be included here? Is that what the question is?
Yes, that's
that is
the
how I
question.
understand. Yes.
Okay, so then we would assume that would be a retirement, so that would not apply to a pension fund. So the question then is whether it will apply to a 13B administrator. So that's where the 13B administrator is non-compliant with the law. No, I don't think they would have to complete it here. So we will, obviously where they are in breach of the laws, we will detect that information somewhere in other parts of the return. But maybe if our colleagues from the retirement funds are here, if they could come in and assist with this question. Otherwise, we can revert.
Takalani's hand was up. Takalani, may you please come through?
Thank you. Audrey, if I understand your question correctly, from our side, if you're an employer that's in breach, for your retirement fund contributions or reporting, the institution that manages your retirement fund will then report the arrears, but they're not going to report it as an employer. You would have seen on the return, it's not marked as an employer. So where we would find your name would be in the monthly reports that the retirement fund submits to us. And then they would tell us what action they're taking and how much is in arrears and all of that. But it won't be on this return, no.
Okay, I'm asking the questions because the return as it was published does not indicate who this will apply to. That's why I'm asking. So you're saying it will only apply to retirement funds and 13B administrators. Thank you.
Thank you.
Apologies if I might just come in, Chair, quite rudely so. So Audrey, there are other sections where we ask about your risk tolerance levels, which obviously speaks to breaches where you have had breaches during a particular year, a particular reporting period. So as part of that, you will include your this breach as part of that count there. But like Takalani said, the intention was not to cover, to require institutions or employers to report it here under 5.8. Thanks.
Thank you, Lorraine. Yeah, I hope that provides you with clarity, Audrey.
Yes, thank you.
Okay, it's a pleasure, Hans. Let's start with Tembisile Cindy, and then we'll go to John Bezanoon. May we please, Akashan, can you please unmute them? Or is it already sorted? I see. Tembisile, please come through. Tembisile, are you still
Can you
there?
hear me? Yes, I'm
Yes, I
there.
can hear you now.
Thank you very much. I appreciate a lot for your explanations there. For 5.2, when it came to unclaimed collections, I have three questions that I'm asking. The first one was the claims that not collected. I just wanted you to assist me with that. There's a definition where I was trying to think of that while we were talking about the unclaimed definitions. In the case at which of reinsurance, let's say a person paid a premium, and then after paying a premium, let's say the asset that you'd record for 100,000. Obviously, in your books, there's somewhere we're going to account that this person is insured for 100,000 somewhere. So, in the books of the entity, to an extent, there is an asset of 100,000 that would have. So, could you please assist in that and check if is it the same asset that you define there or not? And so the 100,000 cover, obviously in my books as an entity, I'll have to record it as an asset. So I was just trying to get how do you put it and where do you put it there, and whether it would fall on the unclaimed assets and so forth. And then the second one is the second questions I wanted to ask was
Sorry, Tembisile, before you go to the second question, colleagues, I just want to ask, did you hear the first question? Can I just get a thumbs up or
So
something?
I heard it, but I'm not sure that we understood it. Are
Okay.
we asking about understanding how to determine what is the asset that you hold as an insurer? So if you are the insurer, you have to complete the return, whether the asset is the vehicle of 100,000 that you are insuring, should you show it as 100,000 because that is your liability, or should you show it as the actual value coming in? Was that the question, or was the question how do you determine unclaimed assets? Because I heard unclaimed in between as well, so I'm not 100% sure.
okay. Thank you, Jeanette. What I'm trying to get to is for the unclaimed assets. I'm actually saying, let's say a funeral, let's say a life cover worth 100,000. So a person might be paying premiums, but then there's also the 100,000, which is an asset to a certain extent, or a liability. So my question was, in the case at which the 100,000 is an asset, can't it be regarded as an unclaimed benefit because of it is 100,000 that is not yet paid to the client that pays the premium, but to the books of the entity, you understand, it is not yet paid. So we still hold to a certain extent a 100,000 investment, or is it a liability? So it was from that particular perspective that we should ask the question. Thank you.
Yeah, Juanita?
Okay, so I have the question now. Do you want to get the other questions,
Yes.
Athule, before we answer?
Tembisile, please proceed so we can then we'll move to John. Okay. Tembisile, I think you had a second one.
Are you calling for me?
Right.
Apologies, John. Tembisile is just asking his last question,
Yes.
and then it'll be you.
Sure.
Okay.
With regards to the, I was looking at your mobile applications and all that. Recently, mobile applications and collections and whatsoever. I've been experiencing. I'm a financial service provider, principal officer. It's category 1, FSP 542. So what's happening is I've been having a difficult time trying to access the debit check systems. So what you find, the banks themselves, they don't allow us to. I don't know what might be causing that. So I was going to the instance of having a difficulty with those things. So with banks approving the debit check systems, because I was trying to take from a perspective of a mobile application. So I wanted to understand if a mobile application is digitally and completely digitally made, and it is digitally made and completely digital, and we don't have any signature approval, and in an instance there is a debit check approval within it. So wouldn't it cause any conflict? I just wanted to understand from the particular perspective. Thank you.
Thank you, Thembisile. We'll now move on to John. John, please come through.
If you want to, thank you very much. If you want to answer his questions first, and not to skew my way of thinking by that, you're welcome.
You may proceed, John. No worries. Once
Okay.
we have the questions, we'll just go
Thank
to
you
the
very
answers.
much. Just
Sure.
to give you a bit of a background, that I am in this industry for nearly half a century. So I do know what I know. And by the way, thank you very much for the FSCA of getting to this point of probing the business. The financial services business, being the largest sector at the moment, is very significant. And the reinsuring business of the world wants us to be risk managers and not just advisors or brokers or whatever else we are called. The backdrop of that is I used to be in corporate. I'm now nearly 30 years on my own. And it's the most difficult thing of all, and excuse the ranting, is to be small, to be a small professional, not to be in the space of huge human resource schlep and all the insignificant laws we had to abide by. So the 80% of all FSPs licenses, more than 80%, is 6 and lesser in a practice, in a professional practice, of which I think it was 68%, only 1 professionals in a business. It's an entrepreneurial environment, hating administrative tasks, seeing it as unnecessary, and the entrepreneurial business owner is an animal that you need to contend with, and we allowed to be in business. So just that as a bit of things out there as background. What I am very perturbed of, especially the smaller, the 70% and under professional entities. We compete with lawyers, engineers, GPs, specialists in the medical field, which are all of them always behind on their work. It's a known fact scientifically. I was part and parcel of it. How many clients can you serve per one person? Comes out about 120. 120 clients can let you have a very amicable life till you die. You won't be able to retire. You have to work till the end, but till you die it is. So what I mean by that, we are taught, for instance, do I have a degree in risk management? Yes, I have. That includes all insurances and everything that goes with it. Risk management is about to be trained with facts to easily identify a need, package it, and result it in a product offering. Not selling, but servicing. Servicing. The bigger firms are in the selling environment that is totally something else. And they need, drastically, they need to be regulated. Our space, we only react on the impulse of a need. Those transactions, for instance, where we have to report on communication, we are already behind on our work. Just a side entry of what happened here today and yesterday and all the others that will come. We spend the time identifying what we have to answer. Can you imagine if I sit with that form in front of me in my already time-constrained environment, and I have to figure out what I need to put on a piece of paper for someone else who is not even paying me for the consultancy, but to have that information packaged. I am scared that the end result will be skewed by either lying on those reports. My suggestion would have been that there's enough professional organizations. And by the way, in this all, I don't even think they attend, is the SAIA and ASISA associations, who sit with amicable, and they should have even more with the AI offerings. But I don't see them anywhere, like in COVID as well. Not even one single report or a press release of how they see all this. They sit with all the information. They are the conduits of all the insurance companies. Being life or short-term does not matter. And then you have the individual, or take the top 10 at least, insurers who sit with AI offerings of billions of rand, and every single input that we do. Now, I stop there quickly. I will commence now. But for instance, with reporting on communication on my 200 clients or whatever I have, I put out about 120 emails per day. Now, the question is, how many times do you communicate with your client? I simply don't know. I'm only a professional with a laptop or a desktop. I have a secretary that monitors my flow of communication, whether it's technically correct or just assists me to get through the day. So the point is that we simply don't know. We don't have the means on our computers to see what the communication flow per person is or will be. If I must appoint or add extra IT capital, it's of no use for me to be in this industry and amicably produce solutions to customers' needs. Now, back to the point. Every single input that I do, every single transaction reflects with an insurer or assurance business in this country or overseas. I don't do business overseas, but if I have done. So it would have been much easier for ASISA to get on the live side all your questions or all the need that you would have wanted packaged through AI solutions, and the same with SAIA on the other side. And then the remainder come back to us and ask for it, which we gladly will do. It's not that we are against any reporting. But if you take, for instance, that we must confirm, I have 27 contracts, confirm 27 times a year just on my BEE status. It is ridiculous. Plus then all the others that we need to do on your accounting principles. So I'm just scared that this, how good it's intended to be, and I agree with it, that you won't get the result. For instance, if I must report today on withdrawings from investments, tomorrow it can be doubly that or half of that. So you will never be able to have a clear picture on one. You will only have a picture on one day, but not a constant picture. There's billions of transactions a year. And nobody can answer me on that, and that is actually dangerous. I've asked many a times in gatherings, do you know, you the regulators, how many transactions, financial transactions are affected every day or then per year? It's billions. So the bad is, if you put that in percentage, is lesser than 1%. It's not even a percentage. but and we doing all this very, very expensive. It's like the RE exams, billions spent, and the investment has not even proven 1% success or then rendement. Now, the expense of what you're busy doing, it must
So,
be vast.
John,
So
can
yeah,
I ask that we are running out of time, and
yes,
I
we
am
don't.
hearing what
No, but we also
what you're
don't get
saying.
chance to say these things to you. So thank you, yeah.
Yes,
But
that
I
is
will
why
stop
we
there.
have
Yeah, I
the
think you get the idea.
yes, yes, and
Thank
we
you.
appreciate your comments, but that's why we have the comments template as well to give comments. This is really just for the Q&A process, but I do see that Asisa answered and said they do not have this type of information. And maybe just to also assist you when giving the comments, we do take note that it is time-consuming and expensive, and there's a big expense done by the FSCI as well in terms of getting this new SupTech system. And it is so that we could better supervise and that we can answer questions such as financial transactions and all of those type of things, step into the next level and into the future. Plus, we are asking the information for all entities across the industry for a reporting period, whether that will be, like we said initially, it will start annually. As we refine the information, it will change over time, and as the information matures. And then it would be applicable to all entities in that sector for that period. And that's the best way to do benchmarking and also to pick up any emerging risks in the industry and be more proactive as a supervisor. And that is what we're aiming at, so that we can protect customers, which is our ultimate mandate. Okay, so Athule, but thank you, John, and I'm looking forward to your comments that you will submit to us. And remember, we especially invite on the comments feedback regarding specific areas that you think will be difficult to report on, and why it will be, and by when will you have that information. Because we're also convinced that the information that we're asking in the Omni risk return is necessary for any business, even a smaller FSP, to run the business successfully and also be proactive in your own business. Okay, but thank you. Yes, it is very good to hear the comments. Okay, Athule,
I'm going
then
to
we
ask
need to
that
go
we
back to the
first.
original question.
Yes, I was going to
also.
say, I'm going to ask that we need to answer the
Tim
questions.
Busili.
Yes,
Okay, so
Tim Busili.
I'm going to try and
Sure.
remember, and then Lorraine and Marrelie, please do come in. The first one was about insurance policies. And if you have an insurance policy, and that is, it's not due yet, so it's a liability of the insurer, can it count as an unclaimed asset? I also saw questions in the chat asking about insurance and insurance policies. Can it be seen as an asset? Even for question 5.1, never mind the unclaimed asset question. I think that's maybe a bit of an easier answer. But if I look at the comments, Lorraine and Marrelie, I think there is a need to maybe define assets. So for this section specifically, so that we also touch on that, because there's a further remark made by Roy about your premiums when it comes to insurance policies, whether that is seen as assets or is it the policy, the value of the policies. There was quite a few comments straight through on assets and insurance, which I think we might need to give comments on. So Tim Busili and everyone in the chat, thank you for highlighting that. I think we will go back and give this some further thought on how to refine it. Okay. Then the second question was to do with the premium collection. I must honestly say, I am not 100% sure, is any of my colleagues able to come in there about the premium collection, and if it's, I think, done by USSD. Timbisile, your second question, because I see you're making remarks in the chat about a reinsurer, but that wasn't the question. It was something about premium collection. I'm sorry, I struggled to hear you while you were speaking. Yes, now I know. Yes. What was the question about the premium collection?
For the premium collection, it was about mobile application.
Yes.
And mobile applications and the debit check. I was on mobile applications and debit check systems. So I was going to a point of saying that I was explaining that having a mobile application that has a debit check system embedded in it, ordinarily you wouldn't have to, would it? I was trying to get the terms or maybe some guidelines at which the application would be considered or be most effective if one would go in that particular perspective. And the ease again, I was actually wanted to understand again the ease of getting the debit check system again, that which we could use. And then with regards to the question I just replied on now, I wanted to elaborate. You said that when one person gets reinsurance or pays the premium. So I just wanted to emphasize that it's when let's say the person pays me the premium and then I pay for reinsurance. So in my entity, it's going to be an asset. You understand? So it was from that perspective that which I had said now when you're talking about unclaimed assets, because I'm getting the premium, it's a liability, and then I pay a reinsurer. The risk goes to the reinsurer.
Yes.
So to me, it's an asset to that particular perspective. So now when you're going to talk about unclaimed assets now, that's from that logic that I wanted to take. Thank you.
So I do think that ties up with the remark that we need to give some clarity on assets and what is meant by assets, particularly for the purposes of this return. And we take note of it, and also then to include that bit about reinsurers. I must say, we did think that maybe the banks would have more questions on that than the rest of the industry. So you're surprising us. In terms of mobile applications and the collection of premiums and the debit check system, who of the colleagues want to come in and take a first stab there? My understanding is with the debit check system that it's still run by the bank. It's part of the authorization to the bank to actually, so it's an instruction to the bank to make a certain payment to someone. So I wouldn't say that's premium collections through a collection of funds through a mobile application if you use the debit check. I don't think that is what we intend there. But please put it in the comments when you submit your comments. Maybe we're missing something there, but no, mobile applications is not a collecting agency or one that we're providing for. You could always put it under other and explain it. That's why we have the catch all there. But the way that you explain it to me now and how I understand it at this moment is no, that's not what we have in mind. Is that the debit check is just an instruction to the bank to make the payment. It doesn't receive payment or collect anything. Okay, thanks, Athule. Can we go to questions, because I'm very aware of the time. Maybe there's so many questions here, and I'm worried that we might not be understanding all of them correctly. Lorraine, do you want us to take a few more questions? We might run over time, or shall we answer them afterwards in the chat? What do you propose for us maybe to do? Because there's quite a few. I think the one about the assets we've dealt with well, about how to do the licenses. We've looked at that. There's one about how would an independent intermediary, well, there's a few. So how would you want us to deal with it?
Thank you. So I see that, yeah, so it's almost end of the meeting.
Yep.
And if we continue, I am concerned that some participants may have to drop off due to other commitments, and then they don't receive the benefit of this Q&A session. So maybe what we could consider is responding to the questions in writing and making that available to the whole group. That might be more fair, but happy to be guided by the chair and the rest of the colleagues. Thanks.
Thank you, Marrelie. Please come in.
Thank you, Lorraine and Juanita. I'm not opposed to the suggestions, but I do think it is important that you comment on the comments template, because we are going to consider all of these comments. It may be difficult to get back to all of you on every single one of these questions. It is going to take some time for us to work through all of this. And some of the comments and points are very valid, and we have to consider that. And it may result in potential changes. So if you were not addressed today, please put those comments on the comment template for us so that we can consider it holistically. Thank you.
Thank you very much. Okay, Juanita, I think we will have to then answer the questions on the chat. Is that so?
I think, the ones that we're very clear about, we will. The ones that we might not be clear about exactly what's being asked then, if I understand Marrelie correctly, the suggestion is rather that it's been given to us in the comments template.
Yes.
And we can then have a look at it. Thanks.
Okay, perfect. Thank you very much, Juanita. And before we end, I want to take a moment to thank each and every one of you. Your presence here today really matters, not just to the FSCA, but to the future of how our industry understands and manages risk. So every question, every comment, every bit of feedback you shared is shaping something bigger than this workshop. You're helping us build a system that reflects realities, the challenges, and the strengths of our financial sector. As Juanita said, we will respond to some questions there on the chat. Thank you so much for your time, your insight, and commitment. Have a lovely day further. Thank you. Goodbye.
Thank you.
Bye.